Hello, everybody, and welcome to another edition of BullionStar Perspectives. My name is Ronan Manly, and today we're delighted to have on the show Ronnie Stöferle, who is a managing partner and portfolio manager in Incrementum AG in Liechtenstein. Hello, Ronnie. You're very welcome.
Hi, Ronan. Good to see you.
So I've been looking forward to our discussion because I'm an avid reader of your In Gold We Trust report, and you're one of the authorities on the gold market and the macro market as it relates to gold. So I think it's going to be a really interesting discussion. I wanted to maybe start off by asking you, what's the sentiment, the financial market sentiment like in Europe? Because you're based in Europe and you were recently in the States, I see. So is it actually more extreme market sentiment in Europe compared to the States? More of a dismal climate because of the energy crisis, the regional conflict, the high inflation?
Absolutely. After 2 weeks in the US, where I attended two mining conferences in Colorado, I felt like coming back. It gave me some negative emotions because obviously, first of all, the whole sentiment is that negative, that gloomy. And then on the other hand, so my family lives in Austria, very close to Vienna, which is, I think the Ukrainian border is just 600 or 700 kilometers away.
Yeah.
Obviously, there's no fighting going on in this part of Ukraine, but still, it feels disturbing if there's a war that is actually, getting worse and worse every day. I don't see that anything improves or that we're closer to peace negotiations. So actually, it is something that is very concerning, obviously, and I can really tell that the whole sentiment when it comes to private individuals, but also investors and business people, is much more gloomy over here in Europe compared to the United States. In the US, I felt, everybody said, well, inflation is high, but it's already coming down. Everybody said, well, the economy is cooling off, but we'll get through that. While over here, everybody is there's no perspective, and that's what's really concerning. So yes, definitely on a relative basis, I felt that the US is once again, like in many other crises, doing significantly better.
And if you look at the difference between Europe and the States as regards the euro and the US dollar, so you've got interest rate differentials and you've got the Fed powering the interest rate hikes. And in some ways, the ECB sort of has to follow through, but they can't really because of the fact that they might cause a recession. The same in America, but it could be more extreme in Europe. And your most recent In Gold We Trust report is titled Stagflation 2.0. So you guys correctly, you and Mark Valek and the advisory board back in November 2020 correctly predicted this huge surge in inflation. And now you're talking about a recession. Do you foresee a global recession or that it could hit Europe more than in the US?
Well, actually, I think, as you rightly said, we predicted inflation to become a real concern already in fall 2020, and we put out a special report called "The Boy Who Cried Wolf." So I always wonder why people say, well, the Federal Reserve is making a policy error. The policy error has already been made many quarters ago. So actually, if they would have started raising rates back then already, I think we would be in a definitely much more comfortable situation now. But what happened since the beginning of the years, like 1 year ago, interest rates were still at zero in the United States.
Yeah.
Now expectations are up to 4.5, even 5% for the next couple of months. So we have seen a huge move in interest rates, also in expectations. And I think that people tend to forget that what has happened this year, drawdown of 60 trillion in global equity markets, in global bond markets, in commodities markets, in real estate, in private equity, in crypto. 60 trillion. That's, I think, 65% of global GDP, something like that. It's a huge number.
Yeah.
So It is, of course, the Federal Reserve wanted to engage in this reverse wealth effect. So basically, they try to reduce inflation by reducing aggregate demand. So people bring asset prices down, so people will feel less rich, and then they will consume less, and this will cause a mild recession, a soft landing, whatever. Now, I mean, this plan also already in theory sounds quite quite challenging, and in practice we are seeing now that, of course, many different markets are breaking, and I think that over the last couple of weeks we already saw how big those cracks really are. I mean, the UK pension system was
Yeah.
basically on the brink. Yeah, there's global banks like Credit Suisse, but also Deutsche Bank. If you have a look at their credit default swaps, yeah, it reminds us very much of 2008. So, but to answer your question, I think this plan of kind of creating a negative wealth effect, and then bringing inflation down. I think in theory it sounded good, but now in practice we're all like guinea pigs, experiencing that it doesn't go so well so far, and and therefore I would say Europe, there's no question, is already in a recession. We always know that the official announcement of a recession always happens um, at that time when basically the worst is already over. So it's always with a big time lag. In the US, I would say, as I've said at the beginning, on a relative basis, they are probably much better off because, for first of all, they have some leeway to reduce rates, obviously, compared to the ECB. Then, obviously, the strength in the US dollar is also reducing inflationary pressures, which helps a lot. So I would expect a recession in the US, yes, but probably not as severe like in the Eurozone. And China is obviously the big question mark. I mean, the numbers that we get from China are not always 100% trustworthy. Let's put it that way. Um, we know that we've got elections coming up in China. But we also know that the zero COVID policy is something that acts like a huge burden on the Chinese economy.
Yes.
So, long story short, I would say if we have a look at asset markets, especially commodities, I think we should be concerned going forward more about a recession than about inflation. So I think that actually inflation numbers for this first inflation wave will come down in the next couple of months, especially in the United States, not so much in the Eurozone. And I expect that officially recessions will be announced. And let's face it, this time around it will not be monetary stimulus running the show. It will be fiscal stimulus. And we said that last year. We called it in Goldman Trust report. We called it the monetary climate change, when we said we should focus less on what central bankers are saying and what they're doing, and focus more on fiscal policy. And I think that 2020 was really it. That was the tipping point when we went from monetary to fiscal dominance. And I think now with the energy crisis, that's a perfect example that actually governments are going direct, and obviously this has a much stronger and faster impact on the economy and on inflation compared to traditional central bank policies.
So when you say fiscal stimulus, some of the examples would include tax cuts, government borrowings to fund subsidies and lower tax revenue, and maybe infrastructure spending to sort of kickstart the economy. Is that what your definition of fiscal stimulus would be?
Yes, I would say it's, if we compare it to 2008, 2009, where it was mostly tax cuts, and those tax cuts, they have an impact, but not as fast and as directly compared to perhaps kind of helicopter money type of policies. So really sending checks.
Yeah.
I think it's also a psychological thing. It's like if you like in Austria, for example, we're getting a climate bonus, which is really complicated, and you can tell that our bureaucracy is really not capable of orchestrating that really well, because those checks are being sent to people that already died many years ago, and it's really
Yeah.
it's really interesting to see how incapable the administration is. But obviously, you've got to. I think if it's a little bit like if you win money in the casino. I mean, I don't go to the casino. I'm investing in junior mining stocks, which is basically the same, perhaps with a slightly better risk reward. But if you win like, 1,000 euros, dollars, or whatever in the casino, you will treat that money completely differently compared to hard-earned money. And I think this is really we're seeing that in practice, that actually people, if they get checks in their post box, in their mailbox, well actually, they just spend it. Yeah, they waste it on whatever. They don't save it. Few do, some by physical gold, but most people just spend it because they don't care about that money. And I think this is from a government point of view. Of course, this is something you can say, well, we did it in 2020. We avoided the big depression, but people got used to that. And now with the energy crisis, I think in Europe, I mean, there was no question um, if governments would bail private households out, and also the industry, that was out of question. That was crystal clear. And I think therefore that kind of confirms my theory that fiscal stimulus will continue to become more and more important. But that's also obviously the road to serfdom, and we're moving more into some sort of a sclerotic quasi-socialist system.
Yeah, like giving the public free funds or funds that they look at as free creates dependency and creates a culture of dependency. So, like back in the 70s when there was high inflation, the central banks of the world hiked interest rates and eventually got out of inflation back and into the 80s and what you call it a 40-year period of moderation. And there's a lot of analogies between what's happening now and in the 70s, but one thing that's quite different that I know you mentioned recently when you were doing various interviews is that the level of debt, corporate debt, government debt, private debt is far more higher as a percentage of GDP than it was in the 70s. You have the same conflict, geopolitical crisis. Back then it was Afghanistan and Iran, and now you've got Ukraine. But is it going to be different this time because the governments are borrowing, they're taking on extra debt? Like the US can continue to raise the debt ceiling, or can it? How can they get out of this situation now the way they got out in the early 80s?
Well, I don't have a PhD in economics, yeah, so perhaps this is why I still have some common sense, but I mean, it's fairly easy to understand. The higher the debt level, the higher the sensitivity to rising rates.
Yeah.
And if we compare the current setup to the 1970s, debt levels are roughly 3 times as high, not only for on a government level, but also for on a company level, and also when it comes to private households. Um, between 2 and 3 times as high. So actually everybody saying that Jay Powell is the new Paul Volcker, I think completely forgets about this sensitivity that we have to rising interest rates. And therefore I think that actually, you know, it's funny, and this was basically in the conclusion of this year's report, where we say, well, we don't believe in this narrative that there is now hawks sitting in the Federal Reserves. They are only doves in hawks' clothes, and at some point, when the pain will be big enough, they will have to reverse, and they will have to reverse very quickly. And I think, over the last couple of days, we got closer and closer to that pivot. So actually, first of all, the fact that the market really believed this narrative, I thought
Yeah.
that's pretty interesting. I once said in an interview, if the market believes that Jay Powell is the new Paul Volcker, then they also believe that Danny DeVito is the next Brad Pitt. So um, not gonna happen, but still, I mean, they still have some trust and some confidence from markets. And again, I think on a relative basis, the US did much better. If we compare the current stagflation to the stagflation of the 1970s, I think there's many similarities. The triggers, for example, coming from energy market, we had the oil embargo in 1973, we had the Yom Kippur War, we had the Iranian Revolution. Now we've got the war in Ukraine. Before that, we had the COVID-19 pandemic and the lockdowns and the massive stimulus measures and the supply chain issues, which is also something that we usually see during wars. Then obviously, real interest rates were extremely negative, and have risen to a large degree over the last couple of months. And then, of course, I think there's also a couple of things that are actually quite different when it comes, for example, to the labor market. Back then, we saw a very high degree of organization in the labor market. Unions were much more important back then. Now we've got, unions not really a very important factor anymore. On the other hand, the difference is demographics. Back then, we had this demographic dividend. Now demographics are acting more like a headwind. So I think that there are many important points to consider, but I think really the crucial topic when it comes to the end of the last stagflation and now this current stagflation, the crucial thing to have in mind is definitely the debt level, which is significantly higher compared to back then. And this just tells me, well, actually, I don't think that we will see a new Paul Volcker that really on a sustained basis can break inflation. My take is that we will see inflationary waves, also a
Yeah.
little bit like in the 1970s, but I think that people also will get used to inflation much more. Like it is a little bit of an emerging market topic. And I think in emerging markets, people are used to deal with inflation. We're just not used to that due to this great moderation that we experienced over the last 4 decades. Nobody knows how to navigate in an inflationary environment anymore. As an investor, as a private citizen, but also as an organization, as a company. And I think we will learn that again, and it will change many pockets of our lives, but it's not going to be the end of the world.
And another thing in the 70s that is very relevant to now was that in the 1970s, with all the geopolitical risk and inflationary risk, the gold price and the gold trading market reflected those risks, and the gold price went higher, a lot higher. But 40 years later, with pretty similar risks, inflationary and geopolitical, the gold price in US dollar terms isn't going a lot higher for now, although it is in other major currencies. Is that because of the sheer dominance of the US dollar right now and that people are flocking to it as a safe haven and not so much gold? And will that change in gold's favor?
Well, Ronan, I think we tend to forget that in spring of this year, actually, we were really close to new all-time highs in dollar terms. People tend to forget. I did a presentation this morning, and people couldn't believe that gold is actually up 8% in euro terms. That gold is up, I think, 12% in British pound terms. It's up 17% in Japanese yen terms. So
Yeah.
it is really the US dollar that is being one of the biggest drivers this year. And I think that obviously many people are a little bit disappointed because we've got a war raging, we've got issues on the energy side, we've got high inflation, and gold didn't really do what they expected. But again, I think it mostly depends on the currency, and I think at some point we will see weakness in the US dollar as well. I think we're not there yet. And I said, I did a fireside talk with John Hathaway in Beaver Creek at a conference. And back then, I think the Dixie index, which is obviously very, very Eurocentric, was trading at 108 or 109. And as I said, well, it actually can go to 120 or over the next 1 or 2 years. Well, actually, it went to 115 or 116 over the course of the next 3 weeks. Yeah, so it can happen very, very quickly.
Yes.
But I think, these major moves that we saw in currency markets, and this is not like the Ethiopian beer or really like a tiny currency. We saw it in the British pound. We saw it in the euro. We saw it in the Japanese yen. Those major moves are already telling me that actually, there's multiple big issues in our financial system at the moment, and there's a huge demand for US dollars. And I think that at some point the dollar will probably die because of its own strength and not because of its weakness. The US accounts for 25% of world GDP, and this share is shrinking, obviously, but the dollar still accounts for 87% of world trade and the majority of global debt. So actually, the strength of the US dollar, this is a huge pressure for many emerging market countries, yeah, that are dependent on energy and agricultural commodities and importing that. And if the dollar rises that quickly versus their collapsing currencies, obviously this has a real world impact for many countries. So I think this whole de-dollarization topic that we write about for many years, this is actually the momentum is rising. And if we have a look at what's going on in the BRICS at the latest summit, but also the Shanghai Cooperation Organization, the SCO, recently with I think 44 agreements in all sorts of different areas, be it infrastructure, be it import export, be it on the currency side, on the trading side, on the organizational side. I think there's quite a lot going on, and therefore I think that the best days for the US and for the US dollar are probably behind us.
Yeah, that rings a bell because I wrote an article about the proposed new Moscow gold standard and a gold exchange in Moscow. And when I did a lot of the research for that, I had to do it through Russian articles and translate them from Russian. And I came across, it was like peeling back the layers of an onion. And I came across the fact that it was initially proposed by the Eurasian Economic Commission, who head up the Eurasian Economic Union. And then the head of that, Sergei Glaznoy, I think.
Yeah.
Glazov, when you researched him, you could see that he was at conferences talking to the BRICS countries and at SCO conferences. So there is a lot going on behind the scenes. And I think his pet project would be to have a settlement unit that would be reflected in the value of a basket of commodities and precious metals and even water, I think they mentioned. So there, as you say, is a lot behind the scenes which is moving away from the dollar. Not sure when that will happen or how long or if at all, but there are, as you say, a lot of things going on behind the scenes. So it also is pretty similar to the parallels that Credit Suisse's Zoltan Poznar writes about with the oil and commodity-backed currencies.
Yeah, well, there's really lots of things going on, and Sultan he brilliantly. I think his last pieces were really good, and you wouldn't expect such pieces coming out of Credit Suisse. You would say, well, if Ronan Manly writes it or Ronnie Stöferle, well, that's fair enough. Yeah, that's what we expect. But we're not coming out of Credit Suisse. Stuff like Bretton Woods 3 and I think he wrote, the new game is basically our commodities, but your problem. And I think that the Western world completely overestimated the negotiation power that we have. Yeah, we're price taker on the commodity side. And I think this is something that we haven't realized yet. The Western world will have to rearm. And we saw that in Germany, for example. I mean, the Deutsche Bundeswehr is like even worse than the Austrian military. But now they are spending like 100 billion on renewing the Deutsche Bundeswehr. We have to reshore. We have to reinvest in commodities. I think that's also a very, very important driver. And it's, there's huge time lags involved. There's coming I don't know, initiatives coming out of Brussels saying, well, we have to secure our supplies when it comes to green metals, whatever that is. Yeah, we need for people realize we're very, very, very dependent, and there will be lots of possibilities. For example, with lithium in Serbia, there's fantastic projects out there. But it will take time. It will take time. We'll need to invest enormous amounts of capital, and there's simply not the workforce, skilled labor, when it comes to mining in Europe. And I think the fourth thing clearly is that we have to rewire the grid. We have to work on our energy suppliers and stuff like that. And I think that 2022 is clearly the year when there was a big paradigm shift happening. And I think when it comes to the sanctions, let's face it, the G7 and the European Union said, okay, Russians, your 630 billion of currency reserves, they're basically worthless. It's just, it used to be a liquid asset. Now it's just a piece of paper.
Yeah.
And actually, I think that the Chinese, but also many other countries that are somewhat critical when it comes to the United States, will probably have a very, very close look at this playbook, at this sanctions playbook. And I think that it's no coincidence that we did a couple of charts on that showing the gold demand coming from consumers, but also the central bank gold holdings and the central bank purchases, as well as the gold production from all the countries in the Shanghai Cooperation Organization, the SCO. And actually, you can tell that those countries, not only on the supply side, but also on the demand side of gold, they are playing a much, much bigger role than the Western world. And therefore, I think that for gold over the really longer term, this whole development will clearly be positive. I think that those central banks and other institutions will definitely reconsider if they should invest their reserves in US treasuries or perhaps in physical gold, which is very, very liquid, which doesn't have any counterparty risk, and which is traded 24/7. So this is like a natural a tailwind for gold. And on the other hand, it's a little bit disturbing that the world seems to be breaking apart,
Yeah.
because I think if globalization was a disinflationary driver, then probably deglobalization is an inflationary driver. And I think from a structural point of view, all those developments that we've seen over the last couple of months, they're clearly all pointing into a inflationary environment.
Well, that's very interesting. And as you were talking about that, I was thinking about the incrementum funds and the incrementum investment philosophy and how you translate your views and the views of the advisory board into the performance or the management of the funds. Could you give us a little bit of background about the various funds that Incrementum manage? For example, I know you have an inflation protection fund, you have a precious metals mining fund, and also digital gold and physical gold fund, and how your views get reflected in how those funds invest.
Yeah, well, we we're still a investment boutique. We manage altogether roughly 300 million Swiss francs. We do manage 6 investment funds, and we do wealth management for private individuals and high net worth individuals. And I think what's really important for us is, first of all, that we understand, or we try to understand, our monetary system. So I think, central bank actions and the state of our monetary system are really the starting point of our analysis. And I think, Ronan, to take a step back, I think, those systemic problems that we're seeing now, if you understand the monetary system and its flaws, then you'll probably go back to August 15th, 1971, and say, well, actually, it all started there. And it's like, if a guy goes to the doctor and say, well, really, I've got such a bad cough, and the doctor can say, okay, well, take some painkillers, antibiotics, whatever, and then it's going to be fine. But he can also ask, well, are you a chain smoker? And if he says, well, I'm smoking 2 packs a day, then probably the suggestion would be to stop smoking. And it reminds me a little bit of what's going on in terms of solving the crisis. It's more painkillers, more antibiotics, but nobody is really talking about the root cause of the problems that we are in. And I think the root cause is probably the center of our monetary system. It's fiat money. It's the importance of central banks. So this is really like the starting point. So, for example, in the inflation protection fund that I'm managing together with Mark Wallach, we're up 18% since the beginning of the year. It's going really well. So we invest in inflation-sensitive assets, mining equities, commodities, commodity currencies, but not stubbornly, like, inflation is going to rise forever, but based on our incrementum inflation signal, that is basically just telling us in which direction is inflation going. And that's really interesting, because actually we have achieved this fantastic performance in a year where inflation protection normally didn't really work. So TIPS didn't work. So inflation protection bonds, gold didn't work so well. Mining stocks didn't work well. Commodities started a big bear market in spring. So our inflation signal told us in late spring, actually, that we're seeing disinflation on the horizon. So we were stopped out of most positions, and now the inflation signal has stabilized, and we started piling into mining stocks, for example, at significantly lower levels. So this is like our approach. It's not long only, but really very, very active. And then we've got other funds that invest just in mining stocks. We've got 2 funds that combine real gold, physical gold, to digital gold, to Bitcoin. I know there's quite a lot of criticism when it comes to Bitcoin, especially from the gold camp, but it's also going the other direction. From my point of view, it's about monetary technology. It's about sound money. And obviously, we've got a very, very strong track record for gold over the last 5,000 years. And therefore, the volatility is much smaller than Bitcoin's volatility. But I think that actually both fit together quite well from a portfolio point of view. And this is why we combined it. I don't know if Bitcoin will be around in 10 years, but if it will be around in 10 years, then I think the price will be significantly higher. I'm sure that gold will be around in 10 years. And I can tell you, I'm also very sure that it will continue to do its job. And the job of gold is to protect your hard-earned purchasing power, to protect your savings. It's not there to make you rich quickly. It's there as a monetary insurance. And I think it will continue to do its job. So this is our approach. We are a boutique. We definitely communicate differently. We've got different views. the best thing is, we treat our clients, our investors like friends, like partners, and our clients are happy. Our funds do what we promise that they will do. I think we communicate very openly also if we make mistakes, which happens obviously in these crazy markets. So therefore, we are really very proud about our solutions for our clients. And it is a little bit like I think it's a little bit like a one-way street. Once you get it, once you understand how our monetary system works, once you understand why gold is important, and many people discover gold via Bitcoin, and they ask the right questions. What is money? Where is money coming from? What is sound money? I think then you will never go back and say, well, you know what Mrs. Lagarde is doing now with the 17th round of quantitative easing, and now ECB also buying equities and yield curve control. That's it's gonna be fine. They're doing a great job. You'll never go back. So it's really like a one-way street, and we realize that with our clients. Once you get it, then you probably have a completely different view to traditional investments.
Well, that's fascinating, and it leads me on to what I was going to ask you about. Presumably, because Incrementum is based in Liechtenstein, and you spend your time between Austria and Liechtenstein, and also Liechtenstein is on the border of Switzerland, and all of Germany, Austria, and Switzerland are German-speaking countries. When I was researching for various articles in the BullionStar Gold University, we did a series of profiles of all the gold markets around the world. And some of the big ones in Europe, as you know, are Austria, Germany, and Switzerland. So you have all the big refineries, you have mints, the Austrian mint, and investor demand for bars and coins in gold and silver is absolutely massive, as you know, in Germany, Austria, and Switzerland, always is. So presumably a segment of your clients are from those three countries, but is it actually easier to convince German-speaking populations about the benefits of precious metals because they're sort of like preaching to the converted compared to other countries in Europe?
Well, I think, Ronan, it's in the German-speaking world. First of all, you've got, next year we've got 100 years of hyperinflation in Weimar Republic. Hyperinflation in Austria happened 1 year earlier, so we are celebrating it in Austria already, and I think this is so, due to the hyperinflation that we experienced in the German-speaking world. I think it's a little bit in our monetary DNA. So from our grandparents, for example, it was just normal to get little gold coins for graduation or birthday or Christmas, whatever. That was just natural because they lived through quite a lot of monetary reforms, yeah, and they lost all their paper wealth.
Yeah.
So if you had gold as a monetary insurance, that obviously always helped a lot. So this is really very important, and I think that compared to the United States, for example, where people are still scared of the Great Depression, which was based on a mainstream view deflationary. I think this also kind of explains why gold doesn't play such a big role in the United States. Yeah, so I think they fear deflation much more in the United States than we do in Europe. While over here, really, there were so many currencies over the last couple of decades that compared to the US dollar, which is around for quite a while now.
Yeah.
I think this explains a lot. But then, of course, on the other hand, I started working in a bank and I wrote my first In Gold We Trust report, and it's just normal to go into every branch of a bank and just buy gold coins, yeah, little Philharmonic coins or Krugerrand. So this is very natural, and therefore I think private individuals, but also investors in general, but also the central banks over here have a very high affinity for gold. So it's definitely something important here. But if I compare, for example, if I go to Dubai or to Vietnam, to China, also to India, I think there it's even more important and obviously in high inflation countries, I always say that at my presentations, I did presentations in 35 countries all over the globe, and the best questions were always asked in Istanbul, because Turkish people, they really know what inflation does to you and your portfolio. So they knew their gold really, really well. And I think with inflation reappearing in the Western world, I think that gold will become, from a kind of a satellite investment, something like this kind of backward thinking relic of the past. I think it will become more and more, into the core of portfolios. I think it will become center stage again, due to inflation, and that makes me really, really, really confident regarding our business, but also regarding the In Gold We Trust report, and really sober and solid analysis of the gold world. Yeah, I really hope, there's so much gloom and doom research out there. I'm running a business. I've got a family. I think life will go on. It will be challenging. Gold will probably help in these turbulent times, but I think, life will go on, and therefore I think it always bugs me when gold is being labeled as something for people that hope or desire the end of the world, hyperinflation, and the Third World War. Yeah, I think you can also make quite a positive case for gold, and that's what we try to make.
The name In Gold We Trust, it's a fascinating name, and it's amazing that you have that. Hopefully you've got it trademarked worldwide, because in the times coming up and in the current times, it looks, In Gold We Trust is a positive message about a beacon of light, somewhere where there is stability and wealth preservation. So well done on the name. It must have been around 2006, I think, maybe was your first report, was it?
2007, yeah. Well, actually, I have to say, I don't know how I came up with that name. I learned about, and we wrote one piece about trust, how important trust is, and we researched the topic of trust really at length, and it's really fascinating. But when I started the In Gold We Trust report, I didn't realize that's a pretty good name. So I was lucky back then. And I think, the topic of trust and this, let's say, the erosion of trust that we're seeing, not only when it comes to politics and the economy, but also to our society. This is clearly something, a long-term trend that we are seeing now, and this trend has clearly picked up in momentum recently. And the problem with trust is it takes ages to establish that trust, yeah, and then it can break very, very quickly. So I think, gold, has established that level of trust for centuries, yeah, for a really long time, and I think it will continue to not disappoint us, and to make its job, as I've said, protecting purchasing power.
And I think that's a great note to finish on, because a very positive message. So thank you, Ronnie, for your time. That was fascinating. I'm really glad we had a chance to talk, and I think everyone will get a lot out of this. So thank you.
Thank you very much, Ronan. Pleasure first seeing you.
Yeah.
I hope we'll meet in person soon.
In the future, I'm sure we will.
Okay. Perfect. Thank you very much, my friend. Thanks.
Thank you.